In this module, we will go through salient features of Companies Act 2013. Now, Companies Act 2013 was drafted keeping two things in mind. The first was to ease the process of doing business in India, and the second was to improve corporate governance by making companies more accountable. Companies Act of 1956 contained 13 parts, 26 chapters, with 658 sections and 15 schedules. Now, Companies Act of 2013 is divided into 29 chapters containing 470 sections with 7 schedules, and it replaces the Companies Act of 1956. Let us now go through some of the salient features of Companies Act 2013. One change was the introduction of a one-person company, or what we call the OPC. OPC is nothing but a private company having only one member and at least one director. This concept was already prevalent in Europe, USA, China, Singapore, etc. It was first recommended in India by an expert committee headed by Dr. J.J. Irani in 2005. One basic prerequisite to incorporate an OPC is that only natural born citizens of India can take advantage of creating a one-person company. OPC shall have a minimum paid-up capital of INR 1 lakh, and there is no compulsion to hold an annual general meeting. The other category, what we call the small company, means a company other than a public company with a paid-up share capital which does not exceed 50 lakh rupees or has a turnover which, as per its last profit and loss statement, does not exceed 2 crore rupees. The Act also provides for some exemptions for such company from certain requirements relating to board meetings, presentation of cash flow statements, and certain merger processes. The Companies Act of 2013 has also increased the maximum number of members permitted for a private company from 50 to 200. In addition to this, some changes have been introduced in what needs to go into a company stationery. The letterhead, bills or invoices, quotations, emails, publications and notifications, letters and other official communications should bear the full name of the contact person, address of the company's registered office, corporate identity number, the SIN number, which is a 21-digit number allotted by the government, telephone number, fax number, email ID, and contact website. Let us look at Articles of Association. Companies Act of 2013 has specified that it is desirable to adopt Table F as the standard set of Articles of Association of the company. You can make relevant changes to suit the requirement of the company. Further, every copy of Memorandum and Articles issued to members should contain a copy of all resolutions and/or agreements that are required to be filed with the Registrar of Companies. What are the prerequisites for commencement of business? All companies, be it public or private, registered under the Companies Act of 2013, needs to file the following with the Registrar of Companies in order to commence their business. First, a declaration by the directors in the prescribed form stating that the subscribers and/or promoters to the memorandum have paid the value of shares agreed to be taken by them. Second, a confirmation that the company has filed a verification of its registered office with the Registrar of Companies. Third, if a company requires registration from any sectoral regulators such as RBI, SEBI, etc., approval from such regulator has to be required prior to starting the business. Changes made to the financial year. The Companies Act of 1956 provided companies with flexibility to elect their financial year. This flexibility was completely removed in the Companies Act of 2013. The 2013 Act specifies that the financial year for all companies should end on 31st March. Certain exceptions are allowed if approved by the National Company Law Tribunal. Let us now look at the important changes prescribed for directors of a company. The first change is in eligibility age to become a managing director or a whole-time director. The eligible age limit has been revised to 21 years as against the existing requirement of 25 years. The number of directorships held by an individual has been limited. Section 165 provides that a person cannot have directorships, including alternate directorships, in more than 20 companies, including 10 public companies. A new clause has been introduced in Companies Act 2013 on disqualifications for appointment of director. If a company in which the director is a part of the board has not filed financial statements or annual returns for a continuous period of 3 financial years, then the director stands disqualified. The 2013 Act also stipulates that the company shall have a maximum of 15 directors. Earlier it was 12. Appointing more than 15 directors will require special resolution by shareholders. Further, Company Law 2013 requires appointment of at least one woman director on the board for prescribed class of companies. It also requires that the company should have at least one resident director, that is, who has stayed in India for a total period of not less than 182 days in the previous calendar year. All existing directors must have a director's identification number DIN allotted by the central government. Another important change is in independent directors. The 2013 Act prescribes the case of listed companies, 1/3 of the board of directors should be independent directors. The 2013 Act also provides additional qualifications and restrictions for independent directors as compared to the 1956 Act. Section 150 prescribes the manner of selection of independent directors and maintenance of data bank of independent directors. This section enables their selection out of a data bank maintained by a prescribed body. Resident Director. The Companies Act of 2013 specifies that every company must have at least one director who has stayed in India for a total period of 182 days or more in the previous calendar year. Controls have been put in place on extending loans to director. The company cannot advance any kind of loan or guarantee or security to any director of holding company, his or her partner, his or her relatives, firm in which he or his relative is a partner, private limited company in which he is a director or member, or any body corporate whose 25% or more of total voting power or board of directors is controlled by him. Section 106 of the 2013 Act deals with the appointment of managing director, whole-time director or manager. The reappointment of a managerial personnel cannot be made earlier than 1 year before the expiry of the term, instead of 2 years as per the provision of Section 317 of the old 1956 Act. However, the term for which managerial personnel can be appointed remains as 5 years. Further, the 2013 Act lifts the upper bar for age limit. So an individual above the age of 70 years can be appointed as key managerial personnel by passing a special resolution. Let us now look at clauses which are relevant for key managerial personnel. The provisions relating to appointment of KMP applies to Chief Executive Officer, Managing Director, Manager, Company Secretary, Whole-time Director, Chief Financial Officer, and such other officer as may be prescribed. Now, KMP provisions are applicable only for public limited companies having a paid-up capital of more than 10 crores. Private limited companies are exempted from appointment of KMPs. Attending board meetings. As per Section 167 of the Act, a director shall vacate his or her office if he or she absents himself from all the meetings of the board of directors held during the period of 12 months with or without seeking leave of absence from the board. Simply speaking, attending at least one board meeting by a director in a year is a must, else he will have to vacate his or her office. At least 7 days notice must be given for a board meeting. The board needs to meet a minimum of 4 times within a year. There should not be a gap of more than 120 days between 2 consecutive meetings. Clauses relating to appointment of statutory auditors. Every listed company can appoint an individual auditor for 5 years and a firm of auditors for 10 years. This period of 5 or 10 years commences from the date of their appointment. The statutory auditor of a company cannot give the following specialized services directly or indirectly to the company. The services are accounting and bookkeeping services, internal audit, design and implementation of any financial information system, actuarial services, investment advisory services, investment banking services, rendering of outsourced financial services, management and/or any other services as may be prescribed. Let us look at clauses relating to corporate social responsibility. These clauses are applicable to any Indian company if any of the following criteria is met: net worth of 500 crores or more, or turnover of 1000 crores or more, or a net profit of 5 crores or more. If any company meets the above criteria, the company will have to constitute a CSR committee of the board. 2% of the average net profit of the last 3 financial years are to be mandatorily spent on CSR activity. Contributing to incubators has been notified by the Government of India as eligible for spending under CSR. Financial statements are now defined under the Companies Act 2013. All companies except a one-person company OPC or small company or dormant company are now mandatorily required to maintain the following: 1. A balance sheet at the end of the financial year. 2. A profit and loss account or an income and expenditure account for the financial year as the case might be. 3. Cash flow statement for the financial year. 4. A statement of changes in equity if applicable. In summary, the Companies Act of 2013 is aimed at easing the process of doing business in India and improving corporate governance by making companies more accountable.